Today, why you can't bank on houses. Hello again, it's Martin North from Digital Finance Analytics, world latest post covering finance and property news with a distinctively Australian flavour. Today, it's my great pleasure to be joined by Roger Brown. Hello, Roger.
G'day, Martin. Good to see you again.
Yeah, great to have you back on the show. Now, you did a show a few years ago with me, but we've been both on a parallel path here, saying this Ponzi scheme with the banks and the mortgage industry can't go on forever. And I guess a good place to start is, when did you start seeing the cracks appearing?
Well, it was actually around about 2006 in Australia, which was before the subprime problem in the US. And the reason I was looking at it then at that point was, as an old timer, I'm used to the fact that house prices always went up roughly in line with the CPI. And that's in all Anglo-sphere economies. That's always been the case for something like 80 to 100 years. So 2%, 2.5%, etc. If you bought a house in the 60s, you paid $16,000 for it. By the end of the 60s, you got something like $18,000 for it, if that. And I was noticing that from 1998 up until 2005, you were getting doubling of house prices in Australia at that time. It hadn't really taken off, turbocharged. And I thought, what's doing this? This just can't happen. And in 2007, it was highlighted by the fact that John Howard, on his election campaign, was interviewed in the street by a bloke of about 20, 21, who said, what are you going to do about these high house prices? They're getting out of control. Remember, this is 2007. And he said, hey, listen, when he talks, no one's complaining about their house prices going up. They're all loving it. And I thought, this is out of control, because we're now talking about more than shelter for people. Housing's always been shelter for bringing up families, etc. And here we're talking about the increased wealth backing of individuals by reason of the fact that their house prices have gone up well in excess of what they should do. So I really couldn't work out why it had taken off like it had until I took some interest in Wall Street and the fact that the Clinton government had put through the repeal of the Glass-Steagall Act of 1932, 33, whatever it was. And this was the atomic bomb, in effect, because it allowed banks that were simply Wall Street bankers to move into housing. And as you know, savings and loan institutions were the basis of housing loans in the US, and out here it was savings banks. And so then I saw that large sums of wholesale money were sloshing around Wall Street, going into housing, as securitized loans, all that sort of thing. And of course, it started to move into Australia without any fanfare. There was no sort of announcement by the government or banks or anything like that. And then you started to see people who were on not much more than welfare benefits buying new houses. So that's when I said, this is out of control. And of course, by 2010 and 11, I think about 2011 was when you started saying the same thing. And we both got the label of silly old bastards. That we didn't know what we were talking about. And it only got worse. And people were, they were laughing at you and I, amongst other people, saying, yeah, look, eventually you'll be right. Like the broken clock. It's correct twice a day. But nevertheless, on and on it went. And you started getting situations, and I know individuals that were involved in these scenarios where in 1998, 2000, they bought a house for 135,000, which was about average then, 3-bedroom houses. And the barbecue talk a couple of years later was, oh, wow, I've just been offered 248 for the house I paid 135 for. And so you had people saying, you know, why would you worry working? And all that sort of thing. Yep. And then the mortgage brokers got into the act, and the so-called, remember, the financial advisors, the independent financial advisors from the banks, who actually got onto my mother-in-law and caused her to angst. And they started saying, now, look, you've got equity. You've built up equity. And these people were not what you'd call financially sophisticated. They would say, well, what's equity? And they would say, well, you can sell a house for more than you owe by way of a mortgage. Oh, okay, that's pretty good. And so the sophisticated commissioned salespeople, and they were so-called members of the staff, but they were also on commissions. They would say, look, here's what you do. You buy another property with the equity you've got, that's part payment on the new house, and you let it out. You get rent. And the rent starts paying for the house. Wow, they all said. And away they went, and they got stuck into the Pilbara, you name it. They went all over the place. And there were people with 2 houses, 3 houses, 4 houses. And you were considered illiterate and dumb if you didn't have them like that. Well, what was then happening, Martin, was that the interest rates at 5%, 5.5%, were what they should have been. You've got to have, as you know, well know yourself, equilibrium in interest rates so that money itself earns income, people who've saved, and borrowing requires payment of a sum, which is income to the other party, and it balances out. And it's been doing that for decades, in fact, a couple of centuries. Well, this started to change. The government started to realise the power of housing values to the average voter. And they started saying, you know, this is part of the economy. We've developed it this way. And if you look at a graph of the interest rates from 2010 downwards, and I was looking at one just yesterday, in fact, I put it on Twitter, it's like a slide, a kid's slide in the park. It just goes down to 0.10% as recently, that Anthony Albanese had a bit of trouble with, but that's no big deal. And so money has effectively been free, excepting to the margin the banks were sticking on of 2.5%. And this is where the politicians never pointed out the risks attached, a double risk, in fact. As you know, in the US, mortgages are for 30 years at fixed rates. And when you bought your first house, and certainly when I did, you did the same thing, the 25 years, mainly in Australia, fixed. We paid 8%, 8.25 in those days, but you knew that it could never go up. You could not get into trouble. And you knew that if you got a better job or a little bit of inflation, your earnings would be higher. No one has bothered to point out to the purchasers of homes, and certainly banks haven't, that we have dynamite in mortgage contracts in Australia, whereby they say that this is a 30-year mortgage. However, at 3 or 5 years, whichever you select, is when we review the interest rates and or the amounts that are advanced. Now, this was marvellous from the year 2000 onwards, because every 3 years, and most people selected 3 years, you got your broker saying, guess what? It's costing you less for your loan now because the interest rates have gone down. Wow. So it kept going crazily. No one stopped to think that the whistle would be blown one day where rates can't go below zero, although I think a lot of people were thinking the banks will actually pay you. You get paid to take on a loan. Well, it's changed from certainly last year onwards. We're now on the way up. And what's going to happen now is every 3 years, if not every 5, people are going to be socked with additional financial burdens with increased rates. I've tweeted that by the 30th of June next year, the interest rate for most mortgages will be somewhere between 5 and 6%. And that means that you're going to have people bankrupted. So that's my summary of the position that we're now in. I blame entirely the RBA, firstly, for dropping the interest rates to unrealistic levels and dangerous levels. I blame APRA. APRA is the worst example of dereliction of duty because they have never actually said to the banks, you are acting unwisely, you're lending recklessly, your valuations are distorted. In fact, they don't value anything anymore. It's just on the basis of what core logic or someone else says. So APRA have dropped the ball, but they've been under pressure from Treasury, not Treasury, Frydenberg himself, who you might recall intervened just a couple of years ago, well publicised, and said, look, it's time for you to ease up a little. This restriction on interest-only loans is causing house prices to drop. And I can remember you referring to this same matter. So he sticks the boot in, and APRA says, yes, good idea, and they have capitulated. And all this has meant, Martin, is that there's been no realistic underwriting on the advancement of loans for housing. And you've got the situation now where people have houses that supposedly can sell for 1.7 million somewhere in Sydney that they paid 115,000 for 11 years ago. What I think is going to happen is that the wholesale money from overseas, that I think it's 30% that the banks derive, you would know that, that's going to start drying up for a couple of reasons. One is that government bonds are now paying some reasonable returns. And if you were a hedge fund or investment group, you might just be tempted by the slightly over 3% 10-year bonds, both in the US and here, as opposed to mortgage finance. So that's going to happen. And the banks are in a worse position than individuals who are trying to roll over. And remember that these loans are all to be rolled over. They don't sit there for 40 years. The banks have to roll over these billions of dollars of wholesale funds. Now, the moment they're told, well, you're not going to get that much this time, or interest rates are a lot higher, then the whole house of cards falls over.
Absolutely. And it's interesting, there's a couple of observations there. Of course, the Reserve Bank used the housing sector and that interest rate lever in response to the mining sector boom falling away in the early 2000s, right? So they were looking for the next growth lever, and with the mining sector disappearing, the housing sector took over, and that became policy. That became policy for both sides of the aisle, so both Labor and the Conservative side, driven by Treasury, driven by the Reserve Bank. The second point there is that one of the things that's changed is the duration of the mortgage. So if you go back to the early 2000s or the 1990s, most mortgages were 20 years or 25 years, right?
Yeah.
Now, typically, they're at least 30 years, and people are actually sometimes getting even longer duration. And one of the things that I come back to all the time is that households now are effectively just a cash flow for the banks, that the banks actually don't want them to repay the mortgage.
No,
right? All they want is that continuous cash flow. Why?
Yeah.
Because they have to service that international investment debt that you mentioned before.
Yeah.
So the financialization of property has got to the point now where the single purpose of shelter, which is where you started, has completely changed. It's been financialized completely. And as a result of that, we've now got a significant debt overhang here in Australia. You know, a lot of loans, 6 times debt to income now. Go back a couple of decades, it was 3 times. So people are more leveraged. And the traditional view amongst bank economists and other watchers is, well, that's okay because affordability is much easier now because rates are much lower. But the point you're making is, but rates are going to go up.
Yeah. Like when they double, you know, whatever you were paying per month before is going to be twice.
Yep.
You're broke.
Yep.
You're broke. This is like purging anything. When you get overindulgence, there is a time of reckoning. And the time of reckoning is the bankruptcy of a few 100,000 people who have borrowed money from banks for houses. It has to be. It is already starting to happen. But the other interesting thing, Martin, is that once upon a time, a debt was a sum of money which had to be shown. It had to be shown that you could repay it, which meant you were amortizing the principal over 20 years, 30 years, whatever it was. And the banks in the early 2000s, and this again is driven by commission motivated people, or CEOs paid 8 or 10 million per year for running the most profitable banking system in the world. They realized that the principal payments are dead money as far as developing profits for the bank's concerned. To give a simple example, on the old system, if you borrowed, we'll take 400,000 as a figure, even though it didn't apply back in the old days. 400,000 over 40 years required $10,000 per year payment as principal, plus the interest. So it might have been, say, a total of 16,000 principal and interest. The smarties at the banks realised that if they had interest-only loans, the 16,000 at 5% or less, 3%, down to 2.5%, the 16,000 had the purchasing ability of a borrowed sum far in excess of the 400 grand that the old system provided. And I remember saying this to a journalist one day, and you know that every journalist in Australia will not talk about the corrupted banking system and the corrupted mortgage system. You would know that.
Yep.
Because they are on the payrolls somewhere along the line. Either they're getting advertising for their newspapers from the banks, or there's some other connection. And when I put it to them that this is what it was all about, they said, "You're talking bullshit. You don't know what you're talking about." And I said, "Well, I do, because it's the leverage you get. If you've got a spare 20,000 per year that you don't need for your family, for clothing, for rent, or all those sorts of things, that sum of money can either be used to just leverage borrowings, the largest amount you can get your hands on, or it can be used for paying off part of the debt as you're going along." And the banks were encouraging the former, the interest only. Which is why APRA never got into the act and said at least 15 years ago, they should have said to the banks, you must not advance housing finance on an interest-only basis. They never did. They only did it once, which I think was 2015. You remember there was a big drop in about 6 months in house prices. And then Frydenberg, the treasurer, decided to jump in and tell them, get your act together, loosen up, we're in trouble with house prices going down. And again, of course, in November of 2020, when we're talking about the pandemic, we get money for nothing. The banks are borrowing at 0.10, whatever it was, and doling that out in the front door at 0.10, big bag of it, out the back at 2.7. So they're making this big difference. And what happened? House prices went up 20%. So all the people under the age of 35 who had no future in house ownership before are wiped out forever. So this is a mess.
It is.
It is an incredible mess. It's social dislocation. There will be social unrest. I never thought I'd see a country like this.
No, it's interesting because, of course, it's happened in other countries too, right? So the central banks around the world have all taken interest rates lower. They've all used the housing sector as effectively a growth engine, but it's all spurious. It's not real wealth. It's all wealth on paper until you actually go to move. But the social consequences are pretty dramatic. And the thing I don't understand is that they don't see that when people are paying a greater proportion of their income just to pay that mortgage, they're not spending it on other things. So in fact, whilst the housing sector might be booming, the rest of the economy won't be because households don't have the money to spend. So they're actually, even on their terms to try and actually drive economic growth and success, it's not even a good measure on that particular scale either.
No. And the other thing is how the political parties, more so the LNP than the ALP, are weaponising housing mortgage. You'll remember about 4 weeks before the 2019 election, when it was looking like Bill Shorten was going to walk it in, suddenly Morrison came up with the guaranteed deposit for new home buyers, first home buyers. And they say, in subsequent analysis of the election, that actually tipped over a lot of votes to the LNP. They thought this is something for nothing. In fact, it's not a huge scheme. I think it's quite small, but it's all powerful. He's tried it again this election in a slightly different way. Even the ALP are mucking around. And all it is doing is distorting and corrupting the true value of housing. There's no 3-bedroom house in Sydney, in the western suburbs or anywhere else, northern suburbs, that is worth 2.4 million for 3 bedrooms and 700 square metres of land. It's absurd. It's insane. It's absolutely insane. And the other thing, Martin, is if they actually gave a valuation to money, i.e. 5 or 6% on deposit, and I might raise the matter, I'm sure you can verify it, but anyone under the age of 50 is going to say I'm talking bullshit again. In 1989, in fact, late 88, early 89, I had some spare money, a reasonable amount. And I put it on 6-month deposit, IBD, interest-bearing deposit, with one of the major banks. I received 12.5% per annum. 12.5%. And that was about just over double the price of leasing a place that you wanted to buy. And, you know, interest rates were far too high then, and you might recall in 1990 they went up to 17%. But the point is that if you had a true valuation, what sort of fool would be in a 3-bedroom house that supposedly is worth 2.5 million, or which he might have paid 2.5 million for, if you could get 6% per annum on IBD or even in a government bond? It would mean that they're paying on say 2.5 million. They're paying what, about 160,000 a year loss of interest. 160,000 a year, as Keating would always repeat. I say again, 160,000 for the honour, privilege of living in a 3-bedroom house. No one's going to do that. So again, that's where it's got out of equilibrium, and the politicians don't care. They're not interested at all.
No, absolutely. And of course, all they do is talk about the supply side issues, right? Which is, you know, it's the state's problem. They're not building enough properties. And yet the cornerstone issue, as you say, it's the credit availability, because we know that the more credit is available, it more pushes house prices up. And that's, you know, essentially the you know, the end of the story. And it's interesting because Frydenberg tried to get the last element of responsible lending taking away last year, to essentially put all of the onus on the borrowers and no onus at all on the banks.
Yes.
And actually, you know, in a small way, we helped some rearguard action there, and they didn't actually get that through Parliament. But you can see precisely the way that the LNP is wanting to drive this, which is more of the same, right? So they want prices to go up higher. They want the debt leverage to continue. They want the party just to go on, except now interest rates are on the way up, and already we know that from our surveys, you know, 42% of households are already struggling with their financial flows even now, before rates go up. So the party's about to end, I think.
Yeah, and it's going to get very nasty very quickly, Martin, because you know that interest rates go up by the stairway, they come down by going up the stairway, slowly and measured, and they go up by jumping out of the window on the floor. That's always been the case.
Yes.
You can think of 1961, 1974, any of those crashes. That is what happens. You don't actually get time to think, what should I sell for, or anything like that. You're out the window. It's gravity.
Yep.
You know, seconds to hit the floor from the 12th story. That no one's taken that into account. And the dopiest people in the land are APRA. There's no question. They keep saying things like, we are comfortable. I love that word, comfortable. We're comfortable with the level of house prices. It's like these new words that are always thrown in. They use challenging. In our days, your days, mine, you'd say as a company, we're in difficulty. We're having difficulties. You know, it might be credit or whatever. You now say it's challenging. So
it's an opportunity.
Yeah. These people who thought they were going to get 1.9 million for their house and kept off 1.1, they're going to be tempted to say it's challenging. No, it's more than challenging. It's bloody disaster, because they're not going to get out in time anyway. Remember also the personal guarantees and the bank of mum and dad that are dragged in on the perimeter of these loans for people under the age of 35, for example. Watch when the banks come running for them. And as I say, Martin, the catalyst is going to be the overseas wholesale funds drying up or being on much more onerous terms for the banks. The banks, in the end, are going to end up in a worse position than Mr. and Mrs. Blogg with their $700,000 mortgage for a house in Sydney.
Absolutely, because the point isn't it, that if one person gets into difficulty, that's their problem. But if you have a whole group of people all getting into difficulty at the same time, as we saw in the US and in Ireland and in the UK around the global financial crisis, then that creates a financial stability risk and the risk to the banking system itself. Yep. And that is the thing that nobody wants to talk about, right? But actually, we should be talking about it because there are some big questions that we have to ask about the ability of the banking system to handle this.
Yes, because you've got counter parties in all of these transactions, wholesale funds, etc. There were some. You remember the Allen Bond times when. I forget what debt it was, whether it was Swan Breweries in the West, but that was, he had a classic one where he'd borrowed huge amounts. And there were 13 banks in the consortium of lenders. And that was at the time he was just about to win the America's Cup, or just had. And he got one of the banks, and I really can't recall, I think I know it is, but I don't want to nominate it. He managed to get them into a corner where, and I see you nodding, so I think you must know who it was. That bank said, "No, we're not going to wind Bondi up on this one at all. We're not going to ask for the money back at this stage." So this is what happens. That's going to be interesting. But I noticed the ANZ lately, they're saying things, and I try to read between the lines. I try and analyse it, and I'm sure you've worked it out. They've got some sort of, let's call it, issue that they seem to be not wanting to make too public. I don't know what that is, but interesting times.
Well, certainly the ANZ has not been growing their loan book anything like some of the other banks. CBA, Macquarie, Westpac have been growing their books quite strongly. And in fact, Westpac results quite recently, they trumpeted their growth of the mortgage book. But the question that I come back to here is, where does accountability lie? Because all the banks keep saying everything's fine, everyone's got plenty of buffers. The Treasurer says there's 250 billion in circulation, all the savings that people have got, all that government money, it's all there. Everyone is trying to effectively say there's nothing to see here, move on, except that, you wonder whether that's the full story. Yeah,
exactly. And don't you love that word buffer?
Yeah.
I mean, it's mainly at railway stations you deal in buffers. But what it gets down to is, say, all right, you can pay $700 a week off your mortgage. With the figures we've looked at and confirmed. And remember, when we were younger, it was your bank that knew what you were doing all the time. Oh. You come up with statements. So they say to you, all right, we need an extra buffer of 3%. So could you pay, instead of $700 a week, $1,280? Yeah, sure, you say. Yeah, of course I could. And that's their buffer. And I noticed a few of the what I call smart people in Australia talking about mortgage finance. Lindsay David, for example, I love his style. He says, "Yeah, buffer my ass." No such thing, and there isn't.
No, well, that's right. Well, there's two observations there. One, of course, is they don't actually look at real costs. They look at these expense ratios. That was the Westpac asset case. And then secondly, of course, a lot of people are spending a lot more than those ratios just in the normal course of business. And then, recent research from UBS still talks about liar loans. About 1/3 of loans, not everything is disclosed to the banks, or the banks choose to interpret in a particular way, perhaps via a mortgage broker. So their underwriting assumptions may not be right in any case. So you can pretty much be sure that the state of the mortgage books they've actually got are different from the ones they think they've got.
Yes.
And that's another problem. And by the way, a lot of the analysis they do is done at a macro level rather than an individual account level anyway.
Yeah, exactly. And what about the fact that in the Hayne Royal Commission, it came down and said categorically, there is no room for mortgage broking in between the lender and the borrower.
Yep.
And the reasons for that should be obvious to anyone with a social conscience. You do not have a third party that gets another party to enter into an onerous obligation, i.e. incurring of debt, for which they receive a commission. And they get that commission by telling some porkies, telling some lies, influencing beyond their position that they should have. And Hayne pointed to that and said, this must stop. And it was in those recommendations. Now, what happened? Within 6 weeks after the release of those recommendations, the banking lobby, the mortgage brokers very heavily got together and they put the heavies on Frydenberg and others. And lo and behold, it was considered by the government that it was a measure that wasn't in the interests of the Australian economy. Well, what does that tell you? There's corruption. It's wrong.
Well, it's interesting because the first draft report from Hayne, which I thought was a very good report, was watered down in the final version, right?
Yeah.
And you remember Hayne sitting with the treasurer and not wanting to shake hands? That was a brilliant photograph. So he knew, didn't he?
Yeah, you see it every now and then, and he's got a look on his face that is, you can think, oh, he's got an acidic stomach. He's in pain. He looked a bit. You can look at it 100 times and think, the story's being told.
Yeah. And Roger, it's sort of worth underscoring. You were talking about this from a life experience in business. You were connected with Lloyd's, so you're not just an idle observer here. You're somebody who's been in commerce, been in business. And so, therefore, people need to listen to what you're saying because you've got this amazing perspective which explains why we've got to where we got to.
Yeah. I was with the world's largest brokers in London, Lloyd's, C.D. Bowring, who I'm sure you would know. They were the largest in all of Europe. They eventually became part of Marsh & McLennan, now the world's biggest. And insurance broking at that level is finance, very similar to what we're talking about. Commitments on one side to the other party that can be enforced or not enforced, all those sorts of issues. Large sums of money. And this is no different. I had a solicitor that regularly used to ring me up, not professionally, a friend of mine, and he'd say, when I used to let go on Twitter, which was 2010 when I first started, and he'd say, "Oh, listen, mate, just watch it. You give me a bit of advice." I didn't go crazy about it, but I did try and point out that, in my view, the system was corrupted. I say it now because it's been proven. The Royal Commission proved it, and many observers confirm it. So I'm not concerned anymore. So it's all blown up. There is no going back now. There's no saving it. And they keep interviewing people saying, what do you think's going to happen? I read something yesterday. I can't remember who it was that said they're not concerned about the housing market. They think values are reasonable. Reasonable. Well, they're not. And you're going to get lots of people bankrupted. They just don't realise that if you've got a rollover loan, then you are, you know that expression, you're up a particular creek.
without a paddle.
Paddles. They're going to go along and say, well, you know, this $600,000 loan on this house of mine at 2.75%. What are the terms? I mean, for the last 18 years, it's been one of, you better give me good ones because I'm going to go elsewhere. They're going to be told, well, here's the first thing. You're not going to get the 600,000 because the value of your house, we believe, is a lot lower. The most we will give you is 400,000. So you've got to tip back into us 200,000. Oh, well, I haven't got that. Oh, well, we've got a problem. And the wind-ups are going to start to occur. They will have to because the banks otherwise are breaching their covenants.
Yeah, absolutely. Well, they do have covenants, both for their shareholders and also a moral responsibility. I think morals have probably flown out the window over the last decade in pursuance of profit, which of course is precisely what Haynes said. It was a greed-based philosophy and culture, and nothing has really changed. And the troubling thing for me, Roger, is that, you know, we've been watching this for a decade plus playing out, right? We always knew that there would be a point when these chickens come home to roost. They managed to take rates lower and lower and lower and reduce the burden on households by extending the length of the loan and interest-only loans. But they're running out now of options unless they do another term funding facility to give really cheap money to the banks, or unless they open the taps and get more migrants to come in. They'll probably try a few more tricks. But I think that, you know, the fuse is now burning.
Yeah.
Rates are going up, and therefore the world is going to change. And I think it's going to change, and I think a lot of people are going to get hurt in the process.
Yeah, it's going to be a conflagration. Seriously, it's there's no solution, Martin. And anyone that says there is talking nonsense. Bank profits are going to take a hammering. And they're going to say again, we didn't see it coming. We didn't see it coming.
They should have listened to your tweets from 2010. Yeah. Roger, I appreciate your time today. That's been great to catch up with you again. You're highly active on Twitter. We'll put your Twitter handle below as well. I have to say, some of your tweets, I laugh as they come out because they're so potent. So keep it up.
Do they worry you?
No, they don't worry me. I think spot on.
No. Yeah. You don't worry for me, my health.
Roger, thank you very much.
Good on you.
Take care. Keep well. Okay, bye-bye.